If you filed your taxes and feel like you overpaid again, you most likely did. Now's the time to fix that before the year ends. Today I'm going to show you the 3 most common ways that you could lower your tax liability, increase your cash flow, and pay only what you absolutely have to the IRS. And this is going to be a deep dive, so buckle up. Mistake number 1, they do not make an S-Corp election. This is one of the most powerful tax saving tools available to you as a small business owner, and this is generally how it works. If I make $100,000 of profit in my business, I gotta pay self-employment tax on that full $100,000. We're talking over $15,000 in self-employment taxes alone. With an S-Corp election, I could wear 2 hats. Hat number 1, I'm the worker. I'm going to work, I'm working the business, and I'm paying myself, say, $50,000 in salary. Hat number 2 is the owner hat, where I'm sitting back, I'm smoking cigars, enjoying myself on the beach, and I'm collecting the profit. Now, on that $100,000 business, the worker's taking $50,000 and me as an owner is taking $50,000. But I don't have to pay self-employment tax on the full amount. I only have to pay payroll taxes on the $50,000. So I've already saved a net 15% of the $50,000. So we're talking well over $7,000. Most S-Corps can easily save $5,000 a year, upwards of tens of thousands of dollars. Now it's important you stay compliant. You need a payroll service, you need an accountant, you need a bookkeeping and a tax advisor. Now the great thing is, at my firm, we're all these things, so we can deliver everything to you, but make sure you're compliant. On that $100,000 business, you most likely are going to save about $7,000 in taxes, self-employment tax specifically. Now, payroll and accounting services are going to run you close to $3,000, but your net gain is $4,000. Really a no-brainer. And once you get over that $100,000 mark, your savings are exponential. So it's really worth your time if you get over that $50,000 net profit to take that S-Corp election. Now, what are the steps to make that S-Corp election? Well, you have to let the IRS know that you're taking your LLC and wanting to be taxed as an S-Corp. So of course you've already selected an LLC in your home state, and then once you have that EIN number, we're going to file the paperwork at 2553 in order to make that S-Corp election with the IRS. So we send that in. Now an accounting firm like ours would fax that in and follow up with the IRS to make sure they get it. So you want to make sure the IRS has processed your S-Corp election before you start payroll. I hate to start payroll and then find out that the IRS did not process your election paperwork. So once you submit that election paperwork, you're going to receive a confirmation from the IRS, generally in 60 days. Once that confirmation is received, that's a great time to start payroll. Now that first year, I always think you have a honeymoon period, because if we make $100,000 in a year and you start payroll later in the year, you might only pull out about $35,000 in payroll because you started it late. So you have a little bit of a honeymoon period, but most definitely you have to pull reasonable salary in order to be compliant. Now, what's reasonable salary? Well, generally speaking, I would say it's 40 to 50% of your net profit. So if you're a $100,000 business, you want to be around the 40 to 50% range, so 40 to 50,000 in that example, but it would vary. So obviously if you make $300,000, 150,000 might be fine if you're a real estate agent or an IT professional. The 40 or 50% generally works in most cases. Bottom line, if you're profitable over $50,000 and you're not an S-Corp, you're giving the IRS a tip that they didn't even ask for. The second big money leak is doing your own bookkeeping, or worse, not doing bookkeeping at all. And I understand you're trying to save money and you want to do your books, and how hard can it be? Well, have you opened up a QuickBooks account and tried to manage it? Now, granted, QuickBooks does have a self-employed utility that's not terribly difficult, but if you're really bringing in some cash flow and profiting over that $50,000 trigger, you most definitely need a bookkeeper, and bookkeeping is one of the best values out there. Now, if I gave you the option of putting 4 hours of work into your books every week, or even once a month, or 4 hours of time that you could put in growing your business, which would you select? Now, it's one of the biggest waste of your time as an entrepreneur to do your own books. 1, you're not very good at it, and 2, you have to spend every waking moment marketing your business. Every minute that you spend at a desk trying to do your own books, you are not marketing yourself. And one of the most famous books out there in the business community is The E-Myth. And he speaks specifically about this, that you try to do everything as an entrepreneur and you find that you get nothing done. So hire a bookkeeper. It's a great value and they offer a lot. Secondly, make sure you get a tax advisor. A bookkeeper is going to keep the books together, but a tax advisor is going to make sure that you're taking full advantage of the tax code. In other videos, we spoke about the tax code and all the juicy tax savings in there. But if you don't understand the tax code, which you probably don't, you need a tax advisor that's diving deep. So how do you select a bookkeeper? Well, my best advice is get referrals. Don't go online, just look for a bookkeeper. Talk to other business owners that you work with. And as an entrepreneur, you probably work with a ton of different business owners. Ask them, who do they use for their books? And if they say they do their own books, move on. Talk to the next person that actually has a referral. And if they say they have a bookkeeper, ask them a lot of questions. Ask them if their bookkeeper is attentive. Ask them if the bookkeeper works ahead. Ask them if their bookkeeper helps them with their taxes. Ask them if the bookkeeper gives them advice. Really interview that person to see how they really enjoy their bookkeeper. What you'll often find is people have a bookkeeper, but they stick with them because of convenience, right? Once you start working with somebody, it's hard to break up. So you really want to ask a ton of questions to make sure that's a good fit. Now, once you find someone that loves their bookkeeper, get their name and number and interview them. Once you talk to that person, ask them about how they work, what they expect of you, and most importantly, ask them how they're going to give you tax advice. Now, it's one thing to get great books, but if you're not taking full advantage of the tax advice, then you're paying too much in taxes. Good bookkeepers should have a relationship with the tax advisor. If they don't, then you need to make that relationship happen. Now, in a lot of firms such as mine, we actually work lockstep with our bookkeeper to make sure that our tax clients are not overpaying in taxes. So we're doing the books, we're reviewing the books, and we're giving tax mitigation advice. So if you find that great bookkeeper, but they don't offer tax advice, you're going to have to marry the two. Your next step is finding a tax advisor that's going to work with that bookkeeper. Because remember, books is only the foundation of your tax planning strategies. You really need a tax advisor, the architect of how you're going to mitigate your taxes and pay less. If your bookkeeping's a mess, your taxes will be too. It'll cost you a lot more to fix it than to do it right the first time. Of course, if you're lost and don't know where to start, click on the link below. Mistake number 3, not tracking your expenses. And all businesses have expenses. Some might be small, like say you're an IT professional that works from home. Some might be large, you're a GC that has a lot of contractors, has a lot of supplies. But regardless if you're small or you're large, you have to track your expenses. Take mileage for example. Get a mileage log. And today, there's so many apps out there, Mile IQ, and there's tons of others that will help you track every mile that you put on your business. Secondly, track your expenses in the home office. So if we have a home office, we could take the size of that home office against the entire house and take every expense that's associated with that house because it's supporting the home office. So say the home office is 10% of the house. We could essentially take 10% of all those expenses of the house. So lawn upkeep, trimming the trees, the kitchen remodel, any expense that you incur in that house, we could actually take a percentage of home office use. So some of the common mistakes of home office deductions, you have to have a business purpose. So if you're driving for Uber, say for instance, and you really don't need a home office or use a home office, don't take the deduction because you have to document why you have that home office. And a lot of times administrative tasks are in the home office. So one of the biggest mistakes I see is that people have, say they're a stylist and they have a space that they rent where they can do salon style haircuts and those kind of things. And they think, well, I have this space and that's my office, so they don't expense a home office. Well, you can't really do administrative tasks in that kind of salon setting oftentimes. So we could take the administrative tasks that you use in your home office and actually take that as a deduction. So we have to think about where we do our work. Now, business meal. So I see people miss this and overplay the business meal. So I have a lot of clients, they'll write off every business meal or every meal as a business. As long as we talk about business, it's a business write-off. Well, not technically. You have to have a business purpose for the meal. So if you're looking at a prospective business partner or maybe a client or you have an ongoing client relationship and you meet, then that business meal is absolutely deductible, but just make sure you document it. So if we're taking the kids over to McDonald's, it's not really a business meal. Now, if my son works for me, and we talked about that in other videos about hiring your kids, if my son works for me and we go over to Cane's to talk a little bit about our social media strategy could absolutely be a business deduction. But the most important thing is to document it, write what the business purpose is, and document who was there, and take really meticulous notes with those business mills. And the startup costs, so a lot of times that when businesses start, they really don't document what they're putting into the business. And where this comes into play is having a really good financial statement. So we want a good balance sheet. So when a business starts, if you have to put $5,000 of startup costs in there, then you have $5,000 invested in your business, and that helps us create a good balance sheet. And why is a good balance sheet important? Well, it's really important because when you do taxes, if you have a loss, we have to show that you actually put money into that business to take a loss. So documenting your startup costs, including subscriptions, software, maybe coaching that you received, any kind of consulting services. Maybe you joined a networking group like Toastmasters or BNI. Any of those expenses, although they're very indirect to your business, are absolutely deductible. So you need to work with a tax advisor, and if you don't know where to get started, hit on the link below, and I could absolutely tell you how to manage your deductions and what may or may not be deductible for you. So I know you guys are gonna get tired of this, but document, document, document. If you don't document something, it never happens. So document those mills, document that expense, write down what this business purpose was. If you don't document it, but you had a mill at a fancy steak restaurant for a big client, and it's not written down, then it never happened. One of the easiest ways to support and document this stuff is make sure you have a committed credit card. Do not commingle credit cards, do not commingle bank accounts, do not commingle, because if I have a bank account that's supporting my personal use and my business use, then I'm missing out on something. But you might be asking yourself, is a credit card enough documentation? It's on my credit card statement. And the simple answer is not really. You really want to have a receipt where you write down who was there and the business purpose. Keep in mind your credit card statement is just going to have how much was charged. It's not going to have who was there, what was discussed, and what business purpose did it provide. So it's going to provide some support that I had the expense, but I still want to have business purpose written down. So I might write down, I met with Mr. Smith, and what did we talk about? Mr. Smith bringing his books over, Mr. Smith's tax deductions. We want to document what was discussed, so if the IRS ever questions us whether that was a business purpose, we have it written down on our receipt. I might take out my son who helps me with social media, and he say, oh, you took your son out to have burgers, and why is that a deduction? Well, right here we discussed the social media campaign that we're going to run this year, including the outreach to college students. So document, don't commingle, and write down the business purpose for why we're going to take that. You don't need to be a tax expert. That's what you have me for, but you just have to write things down and document what those things are. If you write down why you're meeting with that client, why you have that expense, then me as your tax expert could absolutely help you take those expenses. Your job is to document, my job is to lower your taxes. A lot of times I compare managing your taxes a lot like managing your health. So we might not treat our bodies great, we might eat bad foods, we might know that we should work out or have a physical checkup, or maybe we need to do this or do that for our physical health, but we're just way too busy. And life always gets in the way, and time just goes and goes and goes. And before you know it, we're 40 pounds overweight, our heart has a murmur, our digestive system's wrong, we're just in bad health. And it happens a lot the same way when it comes to our financials, is we always think we can get it fixed tomorrow, we get it fixed next month, and that will catch up. And before you know it, our bookkeeping's not done, and we're not tracking our expenses, and we're not writing down what that meal was for because we're just so busy. And then we realize that we're a year behind. And then we realize we're 2 years behind and our books aren't done. And just like our health oftentimes fails us if we don't manage it, eventually our books and our taxes and our accounting and our financials are going to fail because we don't manage it. So today we talked about get that foundation done. Just like you want to eat right and not always have processed foods and drink too much, we also want to have a foundation in our business where we have a bookkeeper, where we're tracking our expenses. And then secondly, we want to work with that tax advisor. Think of a tax advisor as your doctor, as your functional physician who's helping you manage your business, that's keeping you healthy, that's talking to you ways that you can be stronger, you can keep more money in your pocket, you can mitigate your taxes, and that's what a good tax advisor does. And we offer a free tax planning strategy to show you where you're losing money and how to stop.